Good afternoon, this is Sean Golding with Golding and Golding, here to discuss a little bit about PFIC, passive foreign investment companies for expats. It's very common for expats, non-US citizens, to have different types of foreign accounts that may have PFICs. PFICs are reported and taxed a little bit differently, so let's jump into it. So PFIC is a passive foreign investment company. People think of that, they think of like a holding company, a BVI, but actually where most people get sucked into the PFIC matrix is through pooled funds. So you have foreign mutual funds and foreign ETFs and CCOVs and things like that. When you have these types of investments, you typically have to report them as a PFIC, which means you have to file a Form 8621. There's some exceptions, exclusions, and limitations, but in general, you'll file the FBAR, you'll file the 8621, possibly the 8938, which we'll get to depending on the type of account holding the funds. There's certain elections you can make, like an MTM or a QEF, that may minimize the tax implication, but you have to make those timely. Late elections require a purging election, which requires an excess distribution calculation, which ultimately means you're going to be paying a lot of tax. You could try to do reasonable cause to make a late election, but it's not like an offshore disclosure reasonable cause. There's a lot more required. So let's talk about some of the common expat PFIC situations. One is the UK stock and shares ISA. Oftentimes, not the cash ISA, but the stock and shares ISA will have different types of investments. Those investments may include foreign mutual funds and ETFs. Another very common one is the Canadian TFSA, tax-free savings account. There may be stock in there, there may be GIC and bonds and cash account, things like that, but oftentimes there'll be funds, mutual funds and ETFs, and those are reportable. And then just mutual fund portfolios in general. India, Singapore, Hong Kong, it's very common for taxpayers to own several mutual funds or ETFs, similar to in the United States having a Vanguard, Schwab, or Fidelity account and holding mutual funds in those accounts. So what are some common issues to consider? Well, the excess distribution, which is the worst part about having a PFIC. An excess distribution means that you've received dividends in the current year more than the average of the 3 years, 125% above. So if the current year distribution is more than the average of the prior year's 125% of that, then a portion of the distribution could be considered excess. But primarily how this happens is you've had something like a mutual fund for several years, it's gone up significant in value, and now you want to redeem it. That redemption is typically going to require an excess distribution, which means you don't get taxed at the long-term capital gains tax rate. Instead, you get taxed at whatever the highest tax rate is. Then you have to pay interest for the amount of time it's been sitting in the fund. The current year's allocable amount, that is based on your tax rate for the year. But instead of having a 0 to 20% or 23.8% tax implication, you could be looking closer at a 45 to 50% tax rate. Reporting PFICs can be complex and annoying. You know, if you have a mutual fund account with 10 funds in it, for the FBAR you just report the maximum balance of the account. For the Form 8621 PFIC, you unfortunately have to parse out each fund and report it separately, identifying the value. You have to identify how many units, and then if there's an excess distribution, you have to do that calculation. One thing to keep in mind is there is no monetary penalty for the late filing. You know, you've got 10,000 for FATCA, you've got 10,000 for FBAR that adjusts for inflation. There's no monetary penalty for not filing the 8621, but the return does remain open, which leaves the return subject to audit. Then if you didn't file other international reporting forms, 5471, 3520A, 3520, 8938, you could be subject to additional fines and penalties on those forms. For taxpayers who are out of compliance, there's various programs you can use to get into compliance. VDP or OVDP is used for taxpayers who are willful. It's not technically called OVDP anymore, but it's the offshore version of the VDP program. For taxpayers who are non-willful, there's various other options available. There's the streamlined procedures, delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and is something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.